Nitin Bhavin has also joined. Hi, Bhavin.
Okay, sure. Hi, Bhavin. How are you?
I'm good.
Yeah, uh, Bhavin, I don't know if you're audible.
Am I audible now? Yeah.
Yeah, now you're audible. Yeah, correct.
So Nitin, as discussed, Nidhi will go first, and then in Q&A, both of them will take the questions together.
Sure.
Yeah.
So, a very good afternoon, everyone. Thank you all for joining in on a Monday afternoon. Uh, we are here to talk about an interesting subject in when it comes to investing in markets at this point. We've seen the markets to be fairly volatile. You can say the risk quotient has gone up in recent times, but and yet we are seeing the kind of growth that we've seen in the Indian markets in the last year or so. Uh, after the fall in the pandemic, everyone is talking about the recovery or the revival, and the animal spirits coming back in the economy, capex coming back. So the talk is all about the a start of a bull cycle in the next 3 to 5 years. That is what the talk is overall. So of course, when it comes to any bull cycle, the backbone of that bull is the infrastructure sector. Of course, banking and finance is excluded, but the infrastructure sector is something that is always um, uh, eluded investors as to how they want to ride that wave. The last wave that we saw, the last big wave that we saw, was in from 2003 to 2008. But now we have two seasoned experts with us. In fact, we'll be joined with one more person, a distinguished expert, going forward in this session. But as of now, here are two seasoned experts from SBI Mutual Fund. Uh, Ms. Nidhi Chawla has joined us. She has been a She's been a part of SBI Mutual Fund since 2007. She's managed several schemes in the process, including SBI's very own infrastructure fund. She was working as an equity research analyst, covering various sectors, including real estate, infrastructure, construction. So yeah, she has a MBE degree and has done a CFA, and of course, yeah, carries an extensive amount of experience overall. And we are also joined by Mr. Bhavin Vitlani, who joined SBI in October 2018. He has over 18 years of experience in financial services research. He's done his BCom in an MMS from Mumbai University, and prior to joining SBI, he's worked for 13 years with INAM and Access Capital. He's been covering industrial, infra, and power sector for almost 2 decades now. So yeah, we are happy to be joined by these stalwarts to explain how to how do we understand uh, this wave that a lot of people are expecting in the next 3 to 5 years. So over to you, Nidhi and Bhavan.
Yeah, hi, good afternoon, everyone. Thank you so much for joining today. To start off, I think just to give a little bit background to the way we are looking about this sector, and thank you so much for this humble introduction of both of us, Nitin. We've been looking at this sector, and this sector has been the most volatile and a cyclical sector. So, giving a little bit of background would really help as we set up the context for this. Uh, on the growth side, if you look at it, I think the growth is largely back to the pre-COVID levels, which we've seen aided by the increased exports and the restocking activities. Even the Q2 FY22 GDP grew by 8.4%, and on a two-year CAGR basis itself is also been recovering. When we look at the various economic indicators, the aggregate economic activity, which we actually track internally, they have surpassed the pre-pandemic levels by almost 15% in December as well. And they have been up by 10 to 12% even in the other previous months. Indicators including, EV bills, digital payments, toll collections, rail freight actually continues to, exhibit a very strong performance. So on the growth side, I think we definitely think, and we've been saying this, from last year as well, that we are looking at a cyclical recovery over the next 12 to 18 months. especially, the big bang, the budget that was given last year in FY21, which in fact showed the intent of the government to, to actually push the infrastructure investments in the country, and which also led to, which would also started to get visible in the order inflow that we saw in the construction space, and the overall order inflow that followed through in the other segments. So on the growth side, I think the recovery is well set. The real and nominal GDP growth is expected to grow at 10 and 17% in FY22. On the earnings side, even the earnings have been on recovery since FY21, owing to the cost rationalization that we've seen and the fall in interest expenses, the deleveraging, and the improvement in the banking sector health. When you look at in recent quarters, there have been a demand recovery and the price hikes that have helped in keep earnings growth afloat, despite rising cost of input, which has been the key pressure point in the earnings that we see. So we've seen earnings upgrade, which have been largely in industrials, communication services, energy. And even when we look at the consensus earning expectations today for the next year, we are looking at anywhere between 18 to 20%, which is expected over FY20 to 23. I'm taking FY 20 to 23 as a base. That is largely, because, FY21 had the COVID impact. So how we're looking at in terms of the overall, the cyclical momentum that we set, the CAPEX cycle drivers that we're looking at in terms of building of wealth, there are certain cyclical conditions which are conducive. We can see that there have been a strong earnings rebound in the earnings rebound, which was led by commodities, and the industrial demand momentum as well remains strong. When we look at the construction activity indicators, they in terms of the order inflow, it has been positive on the 2-year CAGR basis. Even the strong order inflow, and there have been commentary from industrial companies, have been a good positive in the last 1 or 2 quarters, and the order inflow tracked by us continue to show positive momentum. Recovery is also visible in the concurrent indicators like cap good imports and exports. And I'm just trying to highlight certain of the indicators which gives us some confidence in terms of how we're looking at a particular sector, how we're looking at this sector, how the indicators are shaping up, which gives us some confidence in terms of how the the earnings are expected to play out. The capacity utilization core sectors like cement and steel is actually showing some improvement and have improved to 70 to 78% respectively. When I exclude the weak regions of South and East, the utilizations have actually been much stronger than 80% as well. So government policy and response have been pretty strong. The tax collections have been strong, which gives us more confidence that the government has the wherewithal and the balance sheet to actually support the infrastructure spend that they have promised. And we can see in a lot of initiatives that they take in the PLI schemes that they've offered, the defense made in India indigenization that continues to increase as we as we speak, and quarter on quarter we keep seeing that momentum continue to build up. The other key factor, that has been there is the corporate balance sheet repair. And the corporate balance sheets are actually the least debt laden in the last 20 years, with the rising capacity utilization, which is a good trigger point for them to invest as well. Large corporates, looking at deleveraging. So Tata, the steel sector saw deleveraging by the tailwinds in the metal prices. Then, cement has seen that. Reliance itself has seen a big. So in terms of the format, I think we've not had a PPT. I'll be speaking about a certain points that we've actually made up, and then probably we can take up the questions. And these are very simple points that we're trying to highlight in terms of what we are indicating in terms of the sector the sector indicators. And the last and not the least, the residential real estate has seen a significant pickup over the last 1.5 years, which is one of the 3 pillars, the residential part, the industrial part, and the private capex. So of the 3 pillars of the industrial investment or the investment capex that we see, the 2 pillars have started to pick up well. The last one left is the private sector capex, which would require some nudge in terms of the capacity utilization and the overall indicators improving further, and demand actually, showing a more sustained momentum where you start seeing the private sector capex also coming in. So this is the background that we're working at. So we're looking at a cyclical uptick over the next over the next 3 to 5 years. However, when we look at the valuations, I think the valuations have picked up over the last 1.5 year pretty significantly. Industrial stocks, if you look at it, there have been a robust consensus upgrades that have happened over the last 2 to 3 months. Even the other sectors, if you look at it, cement, infra, and logistics are trading at higher than historical average valuation. So the way we look at the fund today and the way we look at our holdings today, I think given the re-rating and the valuation, the recovery in earnings is very, very vital to support the further upsides when we look at the overall sector. So in terms of the, so which are the key drivers that we see for this cycle? We do not think that it will be power sector driven. Those large scale capex that happened from 2004, 2008 onwards. I think there will be new sectors that will deliver the capex growth story this time. One would definitely be the manufacturing side, where the government is putting up a lot of emphasis in terms of the PLI scheme or the GST implementation or the last reduction that happened in the corporate tax. And the second would actually be the energy transition capex, which has a manifold investment opportunity in terms of the electrification, EV opportunity that we see, the renewables investment that we see. So these are and then the third would be somewhere the logistics and the data centers and the other capex that we're looking at in the economy, which will be, driving this new capex cycle as compared to the previous cycle, which was very, very heavy towards power and steel. So giving the background, we continue to remain positive from 3 to 5 years perspective. However, given the valuations, we are cautious. So in terms of how we are actually positioning in terms of the sectors that we own and the overweights and the underweights that we run in the fund. Over the last 1.5 years, we have been overweight the industrial segment, which is a combination of both the industrial stocks plus the auto anchors, which have been delivering pretty strong growth. We've also been positive on the construction space and specifically on some of the names in the logistics space. However, we have been running an underweight in terms of the energy and the cement space, given the valuation run-up that happened and the earnings recovery, which took a little longer, and the overall which was already getting factored in terms of the valuation. The way SBI Infrastructure Fund is positioned, we continue to build our portfolio in terms of 30 to 40% of our holdings as a core portfolio, which we hold up for 3 to 5 year period, which is our core holdings, which have some structural drivers in earnings. And we have many examples in how we've actually played, as some of the holdings over the last 3 years, including JK Cement, Timken, Blue Dart Express, to name a few, where we were actually, we got it up at the bottom. We try to actually kept it for a 3 to 5 year period where the earning momentum continues to remain very strong, even Kena Metal for that matter, and which have delivered pretty strong earnings and pretty strong market returns in the fund and have been the positive attributors to the fund. The second bucket is the 20 to 30%, where we take tactical calls over the near term, given it is a cyclical portfolio. We look at the cyclical upticks into certain segments where we see change at the margin. Like we saw in cement 1.5 years back, where we were coming from a long elongated cycle from a low EBITDA per ton profitability to the lowest that we saw in a decade, an improvement in that profitability. Last year we saw similar momentum building in metals. We started to add exposure there. So that is the tactical portfolio that we play. And the rest of the 30 to 40% are actually the large holdings, the large cap holdings that are there in terms of the indices that we have, which is Bharti, Larsen and Reliance, where we also try to reduce the risk on the overall performance of the fund. But the key drivers continues to remain the earnings growth. We especially, given my experience, especially in the construction space or in the entire infrastructure space, I personally believe that this sector is driven by the earnings growth and the order momentum that is there in the sector, and not really it's not really a value play. And we end up actually getting it is a very concentrated portfolio. The holdings are anywhere between 25 to 30. As of now, I think it is 30, between 25 30. So we continue to focus on the earnings growth and where we see the earnings and the structural drivers in place for the next 3 to 5 years. So I think these are the basic, tenets, the way, or the basic, views that I wanted to share. I would urge if Bhavin would want to add something in terms of any views that you would want to add in terms of the sector positioning that we are looking at. Otherwise, we can end up getting into quick Q&A.
Thank you, Nidhi. So you've covered everything. Just to reiterate, we have had multiple false starts for the industrial capex after it peaked in 2011. What we now see is, as she highlighted, the drivers will be different. So electronics manufacturing as a sector, which is completely absent in India, is going to grow multifold. Second, what we see is aerospace as an industry in India come up. Defense and aerospace industry will come up in a big way. We are seeing solar, which have seen a very strong growth in the last 10 years. But pura ka pura China se aa gaya. So now the government has emphasized they are putting PLI, and we are seeing government put up efforts for full manufacturing in India. So Make in India is the theme that we see, but it will be completely different sectors. And we have positioned in terms of stocks where these may be supplying a compressor or a tool. They may have a smaller proportion of the capex, but these are the companies where they have very significant pricing power. The market size of these sectors in India is very small. To give an example, abrasive market size in India is about $700 million. Global market is about $40 billion. Very large proportion in China, because a lot of these manufacturing like electronics, aerospace are there in China, US, Europe. So as these sectors come to India, some of these sectors like abrasives or machine tools, etc., will actually grow multifold in India over the next 3 to 5 years. And hence we position accordingly. So this was just one point to add. We are happy to take questions.
Yeah, great. Thanks a lot, Nidhi and Bhavin. Wait, I'll just, sorry. Yeah, thanks a lot. Yeah, so basically you summed up your reasons for allocating the way that you have in your portfolios, and of course your outlook on the sector. So let us try and look at any kind of questions that our audience has. I don't know if you would like to take this question. Will Nifty hit 16,400 in this fall or before this expiry? You can choose to skip this question.
Yeah, so I mean, frankly, market timing is not something which we look at, and today maybe not the right day to actually talk also, because there's been a very significant fall. Like we said, the valuations have been pretty punchy in a lot of sectors that we track, and I'm glad that people are looking at infra sector rather than the new age companies that we keep looking at, where the froth has been much more. So, which is where if the earnings and the growth are taken care of, I think the valuation somewhere or the other will be able to better capture it. But I mean, just talking about Nifty levels, to be honest, would really not do justice to how we actually try to manage the portfolio.
That's true. On a related level, do you believe that the reason why the markets, the popular reason why the markets have fallen is because the Fed has started giving the hawkish commentary? So do you believe that any kind of reversal of the rate cuts that we've seen, any rate hike, will that have any kind of an impact in the infra revival or the cyclical revival in the country?
So if you, on the market, Bhavin, if you want to take that, or otherwise.
Yeah,
Not on the
so,
market, in terms of the prospects of the sector, actually. Yeah.
see, the way we have seen US starting to talk about tapering, and inflation over there has been tightening. We are not experts about the US, but that is one key reason where we have seen increase in the risk-free rate, and consequently the high price stocks, especially the IT ones, have seen a kind of significant correction, and consequently we are seeing benefit, the impact of that in the India market. Now, when one speaks about the capex, what our experience has been historically as demand is a single biggest determinant of the capex rather than interest rate. So, I mean, just to put in, like, लाला जी को अगर पैसा दिख रहा है तो वो expand करेगा. तो interest rate है क्या, that does not matter. Demand is a single biggest determinant. Steel, if you look at, back in the cycle, JSW steel 7,000-8,000 रुपया per ton EBITDA था, जो बढ़ के 20,000 हो गया, 20,000 rupees per ton. So the kind of profits that have expanded, the profit pools that have expanded, and the balance sheets that have got deleveraged. So India in the last 10 years, profit pool was the biggest missing link. So if one has to expand, the issue of availability of internal approvals was an issue. So consequently, banks were unwilling to finance the capex. Now that profit pools having been expanded, that kind of gives a lot of benefit. And second is the PLI incentives, as we also spoke about, where government is coming forward that here is an incentive, not just the PLI. I mean, if you take multiple sectors, they have sat across sectors, and the inefficiencies which were there from an import standpoint, those have been corrected. To give one simple example, India has an FTA with Thailand, and air conditioners were being imported through a Thailand route, duty free. एक सिंपल चेंज कर दिया, गैस नहीं भर सकते एसी में, तो यहाँ पे अगर गैस भरोगे तो the cost goes up to as equivalent to what you produce in India. So some small things have been done. Multiple of these small things have been done to discourage imports. And these are the ones measures that we are seeing that the opportunity of manufacturing increase in India. So, Nidhi, if you would like to add on this.
Just, overall, when you talk about Fed and, the rate cycle, it's true, right, that the liquidity has fueled a lot of rallies in across the markets. But apart from where, which is difficult to actually time, there are a lot of everything is going up. But when you actually look at the stock specific, now the market actually starts focusing more on earnings as well, incrementally. Where when you're actually focusing on those earnings and the sectors where we actually see the delta of that growth coming in, there will be a clear distinction in terms of what will deliver performance and what will not. So obviously the market becomes much more bottom up specific when it comes to markets like these, rather than when actually there is a flush of liquidity which was available, let's say after 2008, 2009, or when even the recent years when Fed has been pretty much on a loose policy space. So as they tighten, obviously the liquidity is expected to go out, but you will always have those the drivers of earnings which will have to be seen in the context of how the growth and the other factors are building up there. So you may be having the liquidity windows or the liquidity available to you over the last 5 years, but now you're also seeing the earnings actually and the drivers, the growth drivers falling in place. So that will be helpful in terms of understanding how the market should behave.
Sure. Thanks for that, Bhavin and Nidhi. There is a question on the PLI scheme that you mentioned. it has a gestation period of close to 5 years, apparently. And how does this relate to investments, probably in the medium term? When I say investments, I'm saying how an investor looks at his own portfolio. Is it like infra will take more than close to a decade to materialize, or can they look at some upside in the next 5 years? Significant upside.
Sure. So gestation period actually is a bit lower when one speaks about the PLI schemes. So mobile manufacturing, Dixon got the PLI scheme last year, and they were able to start the factory in like 6 months. So similarly, if you look at Foxconn Honhai, they've been able to set factories pretty swiftly. Even the larger capex that so Reliance one for the solar, the factory has to be up and running in the next 18 months. So you will see that as soon as the PLI has been awarded, these companies will have to set the ball rolling in terms of putting capital to work on the ground. And factories have to be up and running in the next 1.5 to 2 years. So the investment cycle kicks ahead of the factory cycle. Then the manufacturing kickstarts. The incentives that have been given by the government in the PLI are for 5 years. And the belief of the government is that after 5 years, the disadvantage that the industry has can be taken care by the scale advantage. And over that period, a lot of the assumption, let's say the mobile manufacturing, 10% of the components are sourced from India. And the assumption is that after 5 years, 35 to 40% of the component will be sourced from India. So an ecosystem creates. So you have the just-in-time concept, locally available, so you can reduce the logistics cost. That is an expectation that over a 5 year, the industry will work towards getting it. And so once the incentive expires, so in the initial period, you want basically it's like just to set the ball rolling. Over and above that, what the government has been doing is they are starting with plug and play manufacturing parts. So if one takes Dixon as an example, they started their Tirupati factory in 90 days. It is unheard of. So everything was given to them. The shed was ready. Power connection was ready. Approvals were ready. They just had to get their equipment and start production. So there are a lot of instances that we are seeing of these kind also. So the government is really going full blown to kickstart the investment cycle.
Bhavin, there are a couple of questions. One is on someone had asked steel, you already answered. Then there is on railway infra, and secondly, what is the expectation from budget on infra? So you can take it subsectors of infra, and you can throw some light on that. So railway specific and any other infra segment, like maybe construction or whatever other segments you want to, steel or manufacturing, or what is our expectation from the budget? And secondly, I also want you to touch base upon how this fund is positioned for next 6 to 9 months, and what is the person who comes at this point of time, or should he wait? As Nidhi earlier pointed out, market time is not correct, but what is the percentage of portfolio allocation he can look into these kind of funds?
So the first question on budget, the expectation is that there will be increased allocation for roads, railways, metro, etc. So one has to be cognizant that this is practically the last full year the government gets before the general election sets in. So the next budget they will not get a full on. So this is the year where they have to actually push the pedal on the accelerator in terms of capital investments. And the ones that can actually reflect to the common man in terms of benefits, like a road or a railway or a metro, you can see and touch and feel, and it kind of portrays the work of the government. So we believe that the allocation of infrastructure will be higher this year versus the last year. And in the previous budget, the government has taken relaxation from the FRBM. So they believe that for the country to come out of the difficult situation, they can get the leeway in terms of fiscal deficit. So the budget, we are hopeful of increased allocation and a lot of initiatives taken towards infrastructure. The second question that you had in terms of on the positioning for the 6 to 9 months, actually we are looking at positioning more on a slightly longer term basis, because given the way the sector is and some of the stocks that are there. So 20% of our fund is industrial manufacturing. And what we have done is we have actually selected stocks which may be mid cap or small cap, but they are leaders within their space. So Kena Metal, as an example, is the leader when it comes to metal cutting tools. Or Carborundum is also a leader along with Grind with the equal share in terms of abrasives. And some of these companies are increasing into new age sectors like hydrogen and battery manufacturing. So we've the 20% of our fund, which is the industrial manufacturing, we have selected the stocks which the underlying industry in which they operate in India is small, maybe to the tune of $600-700 million or some time lower. But these industries globally are much small in multi-billion dollars, tens of billions of dollars. The other one is we have a overweight on the construction side. Again, here what we have taken is, so Larsen is our largest weight in that. And we believe that as the infrastructure in India gets complex and the size of the projects increases, the leaders tend to benefit. And L&T is a very diversified company where you can play not just the infrastructure, but the other sectors, likes of defense as well. So these are the two large overweights that we have. We have a tactical underweight on cement, and that's because what we believe is that the cost push which has been there in the near term might not be fully factored in by the consensus. So we believe there could be some negative surprises on the cost side. So it's a tactical underweight, and structurally we like the sector. We believe that some of these companies have actually come to a size where we can see a strong growth after market kind of factors in the underlying sustainable profitability. So on a 3-year basis, what we believe is we have kind of positioned in a way that some of these are companies with very strong competitive advantages, and the valuations are also pretty reasonable, and can actually give a double-digit compounding on a 3-year basis. Kamlesh, if I have
right, thanks.
Yeah, thanks. Good enough. Thanks.
Kamlesh, you have anything else to point out, or should I finish up with any remaining questions that we have?
No, we are good. Nidhi, you want to add anything?
No, I think Bhavin summarized well in terms of the budget expectations, and it is always seen that the order inflow before elections, it is always seen a momentum building up. Like he said, it's the last year for them. So there is an expectation of 15 to 18% increase. Last year it was almost 20 to 24% that they had seen an increase in terms of the capex spending and the incentives that they have been starting to do out. But whether they have, but on the disinvestment side, obviously there have been a lot of not being able to manage the receipts. So the tax collections could be helpful, but in the overall scheme of things, and the NHI InvIT is another good, the national monetization scheme that they've announced that will also help in terms of getting the finances right, because most of them are like the off budgetary resources that they actually look at. So from that perspective, I think from the monetization perspective, from the national pipeline that they've had, and the kind of the projects that they're trying to give, especially now the green corridor that they recently announced, that has led to that will lead to a good pickup on the T&D side, where we're also looking at positive momentum building up in 3 to 5 years, and we have building up positions in that segment, where we are positive. So in terms of the sectors and segments, I think these are the few spaces that you look at positive momentum over the next 3 to 5 years.
Sure, great. Um, just to reiterate, I think you have covered it. I think you both have covered this point. But just to reiterate, how is your how this infra fund, SBI Infrastructure Fund, how is it positioned in terms of core and tactical allocation, if I may say so, to benefit from the revival and any kind of opportunities in the sector? Do you want to have any thoughts on that?
As I kind of highlighted, like industrial manufacturing, which is 20% of the fund. So we have, as I've said, the companies which are they may be smaller, let's say less than 1% of the capex, but they are the leaders within the industry, so they have the pricing power. Now, there are certain companies which are benefiting for the investment in the infrastructure. So infrastructure, many of these EPC companies have lacked pricing power, but there are companies where the pricing power is excellent. So a welding equipment or a welding electrode, which is a consumable, and when you go to an infrastructure site, the welders who are specialists, they say, if you don't get an X company, it will actually cause cancer to us. So they've kind of come to a very monopolized position, and as the infrastructure activity grows, some of these sector can grow multifold. So there are companies we've positioned in that way. Telecom as a sector, we have seen consolidation. We have seen two players actually gain. So we've kind of playing it through both RIL and Bharati. Along with the retail boom that is expected. So we've positioned in core sectors which are actually expected to see accelerated growth, and hence is our expectation of a double-digit returns over the next 3 years.
Great. Right, I guess
if
you
you actually look at the
covered.
positioning, if you actually look at the positioning today, right? So, like he rightly mentioned, the 20% of the portfolio are on those high conviction 3 to 5 year bets that we had in the industrial space. Plus, we've also have some investments in terms of, let's say, the auto hanks that we've been holding, and the other segments of the DFC beneficiaries like Concor. And so if I look at the Larsen positioning itself, which is the larger becoming more consequential over as we continue over this cycle, plus the other holding that we have, we've almost 60 to 70% covered on this core infra holdings that we've had. Plus on the tactical side, like Bhavin rightly mentioned, I think cement has been a tactical underweight, and we will be looking to trying to cut as we see the cost pressures subsiding, and the other and then we started to add more on the T&D and the other power utility side, where we start to see some value. So that is how we try and position the fund, that you would have to look at it. It will remain as a core infrastructure portfolio. We continue to invest largely into infrastructure related sectors. Even for banks, I think for the past that we have tried to manage, I think it is mostly related to the pickup that we see in the financial savings and on the residential, the overall the housing activity that we are seeing a pickup, where we've actually added some exposure to banks like ICICI Bank and HDFC Bank, and not really into the NBFCs and the other sectors that are there in the banking space. So this continues to remain a very core infrastructure focused fund, to be looked at a perspective from a 3 to 5 year perspective, rather than looking just from 1 year window, because it makes, and like Bhavin actually rightly mentioned, the size of the opportunity for some of the players and the size of the market today is so small that you will actually take time to actually build a position itself, and trying to the numbers actually starts to reflect in. And we've seen in many of the holdings that we've had, how the size of the market has started to expand as the market, as the growth improvement has started to become visible. And many of the stocks have been like multi-baggers in those space, in terms of even for carborundum for that matter, Timken for us, or Sona, that we've had a holding. But obviously the valuations, given the valuations we will be looking to, we'll be revaluating that stock. But that's the EV space, which is the future in this segment. So which is where I always say that you would have to look at it from a 3 to 5 year perspective, rather than taking it as a market timing, or trying to really time that. You can time your allocation, and you can space out your allocation. But whenever you actually look to invest, I think it would be more from a 3 to 5 year perspective, is the way we actually manage the fund.
Sure. Of course, when it comes to a cyclical sector investment like infrastructure, we would always advise all our clients to have an at least bare minimum of 3 years horizon before you start investing. Otherwise, it calls for speculation, if I may say so. So, okay. So I believe we've covered largely the range of questions that we've had. I believe we can move towards commencing this session concluding this session as of now, and leave with your parting thoughts, Nidhi and Bhavin. We also have, actually, just to add to our speakers, we have Mr. Sachin Relekar joining us from IDFC Mutual Fund right after this. So before we take your leave, Nidhi and Bhavin, again, thank you very much for joining in and giving us your valuable thoughts. Any parting thoughts or to our investors who probably do not understand the nuances in the market, and just to give your valuable, you can say, guidance to them. What would be your words to them?
So maybe I just would like to reiterate in a way that look us from a 3 year perspective. We are fairly confident that the capex cycle in India is picking up. We have positioned in a way that we kind of pick the right winners, the companies which have very strong competitive advantage and good governance. And many of these are also a play that exports can also be an opportunity. So we see that some of these companies can outgrow the underlying industry, and the way we have seen in 2003-8 cycle, where we saw many of the companies where the starting point of top line was almost equal to the profit by the end of the cycle. So we do see that there are many of these opportunities which are there in the coming 3 years, and believe that India actually will become a substantial proportion of the manufacturing globally. And along with that, the after effects that can be felt in terms of infrastructure, banking, is where we've kind of tried to position ourselves, and believe that a double-digit return over the next 3 years is something which is where we strive to earn over the next 3 years. Now, we would like to add any?
You summarized very well. So yeah, thank you so much for having us, Nitin, and hope we've been able to resolve most of the queries that people had. Partners, we really don't talk about stock specific activity or particular, the market level, we refrain from that. And yeah, from any time if you want to reach out, we'll be happy to help.
Yes, definitely. Anyone would like Nidhi said, if anyone wants to reach out for any further ado or any further clarification with respect to the fund or the sector, you can reach out to your IIFL representative. You can reach out to the IIFL central team. You can reach out to the IDFC representatives that if you, sorry, the SBI representatives that you would be directly interacting with, and we'll be happy to take your queries. Once again, thank you. Thanks very much, Nidhi and Bhavin, to give your time to us and our clients.
Thank you so much, Jonathan. Really appreciate your time and the audience for listening us and having us.
Thank you.
Thank you.
Then I'll log out just a small query. There are a couple of questions related to other funds of SBI. Can you just note down and forward it to us, and I will try to answer them, because let's not waste other people's time.
Understood. Yeah.
There are a couple of questions related to other funds. Yeah.
Yes, I've seen that. Right.
Yeah.
Sure. Thanks, Kamlesh.
Thanks, Nidhi.
Thank you, Kamlesh. Thank you so much.
We'll log off. Yeah.
Yes, we'll log off.
So yeah, Priyanka, Mr. Sachin, are you there?
Yeah. Am I audible? Hi.
Yeah. You're audible. Yeah. Hi. Thank you for joining us. Very good afternoon to you. Good evening. Sorry.
Thank you. Thank you for having us.
Sure. Great. I will just start with your introduction. But do you have some kind of a presentation to that you can share?
We have a PPT. What I will do is, like, we will not take more than 15 minutes on that. This is just to lay out what is our thinking about this theme as such, and also how we differentiate in our fund itself. So few pointers on that, and if that is okay with you, and I'll leave it to you.
Yeah, and then we can conclude it. Yeah, sure.
Right.
So yeah.
Share my PPT or?
Yeah, sure. Just for everyone's benefit, we are joined here by Mr. Sachin Relekar, the senior fund manager at IDFC Asset Management Company. He's been part of the company from 2020, but before that, he's an industry veteran. He was the CIO at LIC Mutual Fund, Chief Investment Officer, which is like the head of the fund house, where he played a key role in formulating the investment framework, launching ETFs, developing the investment team, etc. His prior stints include working with Tata Mutual Fund and CD Equi Search Private Limited. He's a CFA, completed his master's in JBIMS after his engineering. So thanks very much, Mr. Sachin, for joining us and giving our investors an opportunity, our investors and our employees an opportunity to listen to your thoughts on the infrastructure space and on how your fund is approaching it.
Sure. Thank you.
You can make it full screen. Yeah.
Is this okay?
Yeah. Great.
Sure. So this is just a two parts, and as in the entire presentation is just divided into two parts. One is about the theme as such, and then we'll move quickly onto as to how the fund is positioned to take or leverage upon that. So this is our overall framework. The reason we actually include it in this is we want to say that while it is a thematic, while it is an infrastructure focused fund, we do apply the entire investment framework which is there, and all these factors do also get into consideration when we are investing in this fund also. At sometimes, the perception is infra being a cyclical, infra being more thematic. Some of the things don't apply over here, but we are quite clear about this framework as such, that we do look at all the factors which perhaps also get applied to a diversified fund. So in that term, the quality aspects of a fund or the filtering is very, very strong. And then this is also the part of the same thing, just that what is data based and what are the soft factors where the considerations are important. Those are just divided over here. And then jumping into what is our view on the infrastructure fund sector as such. So first of all, one of the thing is like it's a very broad opportunity, and although it is lumpy and cyclical, if you look at the annual size of the execution opportunity which is available across the segments, is also very, very large. So that is something which get missed by the people, and this is something which we wanted to bring out. While it is cyclical, all right, but just look at the opportunity which is available, and not just one sector. That is another aspect. It is just not just about roads and bridges, but it is also about a very diversified sector. And some of the new things which are emerging are still not into the consideration because they are new. Is something like high speed railway, etc., which itself can be as big as what the entire infrastructure opportunity as of now going on. So the money likely to be spent on that could be in the range of 5 trillion rupees over next 10 years. That is a very large number. So this is one. Second is the evidence has been, if you look at, go back like in time from last 5, 6, 7 years, actually the ordering activity has been picking up quite strongly. And it got interrupted only because of pandemic, where people could not able to access the offices, or bids could not be opened, which is I think is the thing which all the things in the economy. And so it is not to say that there is any break in terms of ordering activity going up or so. And if you look at the players who are ordering, right from not just central government, but all players, which is state, PSUs, and even the private sector, they all numbers are actually on the rise only. So there's a strong momentum which is coming through, and this has been something which is a trend which we don't see kind of having any issues as such. Once we actually have a normalcy, which is expected as the COVID fear subsides, these things can actually spring back much strongly also. And another thing is, while we look at budget, we kind of decipher every detail in that and try to figure out as to whether the number allocated to the infrastructure per se has been gone up or gone down. There is a lot of consistency which makes you believe that there is a growth focus across the budget cycles, across the political cycles also. So that is not a worry at all. There is a focus on growth. Just that how the execution actually goes through, whether there are impediments and whether there is a learning curve on implementing the capex, which actually enables it to move faster or slower, is the most critical part of it. So there has never been a dearth of capital expenditure allocated to this, or financing arrangement being made available for the infrastructure capex. It is the execution where different type of dynamics do emerge. And then what we also thought, that there is overall theme which is there, but how do we actually position, or which sectors we will look at? See, most important, I think, is which I personally, we are actually, and as a team also, we are spending a lot of time in this, is because this is something new, and this is like breaking into a new thing altogether. One is, this is the manufacturing resilience, and this is a key policy focus, because a lot of policy goals actually can be achieved through manufacturing resilience. And over here, some of the things which were actually becoming impediments in terms of executing this, which are also requiring parliamentary actions, or there has to be a consensus developed for that, is something like labor laws are there, which kind of got repealed in certain pockets. State governments have been more active in that. And this is, by the way, a mixed issue of state as well as central government. But there's clearly a sentiment where the labor acts have been looked at closely, whether there can be flexibility brought into this, which is very important. Now you are seeing a lot of these flexi employment firms also actually increasing in the size. Secondly, government actually looked at import substitution as a theme, and there were actively steps taken as to whether there is actual value add which is happening through the imports, or can we actually look at manufacturing it here. So those were the things will also been repositioned and re-looked at it. And now, given the understanding of importance of being properly positioned in a supply chain, global supply chains, there is a clear production linked incentive schemes which are coming through, and they are actually for the newer and emerging sectors, which are like electric vehicle battery manufacturing, and something like mobile manufacturing, where the electronic components per se. These are all things which are actually forming a major part of import bills apart from crude oil. So those are the things also looked at. At the same time, the same thought process has been also applied to some of the traditional sectors like textile or even the tire manufacturing, etc. So what they are doing is the whole thing is actually getting relooked, and most of these capex are actually becoming viable because of this production linked incentive schemes. Also, there is a sunset clause. So unlike the SEZ thing previously, which eventually became a real estate play and which didn't fructify into anything material, over here it is all linked to the actual output, which is incremental output. Much more clarity is there, and it is evolving. It is not like having a one blanket policy, and so each sector having its own customized approach as well. Next, of course, there are strong tailwinds for the manufacturing resurgence to happen. Irrespective of this current talk of interest rate going up or etc., fact remains that we are going through a very low cost of capital cycle, and perhaps it's at a 2-decade low. There could be a marginal increase, but I don't think that will upset the longer term theme of benign liquidity or benign cost of capital per se. Also, government actually took this very important proactive measure in rationalizing the corporate tax rates. And now we are actually very, very favorably compared with respect to some of the peers, and especially the peers who are actually competing in manufacturing sector. So those are the tailwinds which are coming together. And of course, India is now becoming a very important element in some of these MNCs or the large global firms actually re-looking at the supply chain dynamics per se, and everywhere the China plus element is kind of getting added. And in that, not only Vietnam and Korea are considered, but some of India actually getting a very important place because we can give more scale. The policies are more favorable. We are now actually understanding how we can actually accept those larger scale investments also. So those things also coming together. So all these things put together, 3-4 factors which I mentioned. This is one factor which is still looking up, and perhaps we can actually keep watching this space, and more things will actually continue to build on this. Then another thing which we had touched upon is where we also position the fund in a very major way is cement. What we are seeing is the pace of it is a clear thing sector where these are regional monopolies per se, because cement doesn't travel over a longer distance. It becomes uneconomical. There is no threat of substitutes per se in this sector. And at the same time, the sector was actually, what it is seeing is the incremental capacity addition space has slowed down for whatever reasons. Either the players are taking longer term view of the thing, or there is a capital allocation discipline coming in. But the fact is the incremental capacity space per annum is actually going down. And more importantly, there is a consolidation also, like top players are actually commanding a larger capacity share. At the same time, what we are seeing is with all this revival, notwithstanding what happened in the COVID era, what we are seeing is the demand per se, incremental, is actually growing faster than the supply actually has been coming through. If you see that this chart in the top right hand corner, that actually is the most important chart, at least for me, is if you are actually putting up capacity incrementally is actually lagging the incremental demand. What it means is the utilization levels has to go up. Whether that translates into pricing power on a near term or a longer term basis is actually a question which one need not have to really think too much about, because eventually it will come. That is one. And just the incremental or higher utilization itself is actually translating into a lot of other economic benefits of higher cost absorption, better capacity utilization, better scale. All those things means a better profitability, and perhaps they can reinvest in a better manner also. So this is one sector apart from manufacturing which will play a big role. And then finally, this is something is a long cycle, which is the residential real estate. And this, I just confined the PPT in the interest of time just to top 7 cities. If you see the inventories actually are getting absorbed faster, and here also what getting launched per se versus what is getting absorbed, there's a big gap which is emerging. What it means is And of course, what you have seen in this sector where RERA got implemented, and a lot of bankruptcies happened, IBFC cases happened. So this sector is kind of got cleaned also. So there is a not only just a demand cycle revival, but at the same time, industry also gone through a lot of purge per se. And therefore, there's a formalization trend which has picked up in a strong way. And if you look at the size of the industry or the money which gets spent onto this, is quite large. So this is another element which is where we just highlighted here, that those are some of the things which are coming together. And so cement manufacturing and then overall theme is, and of course the final thing is about residential itself. So these are the 4-5 aspects which are making us believe that investing through infrastructure fund across these themes actually makes a lot of sense. But at the same time, there are risks to the theme, which I really want to stress upon. And these are important because people actually take just a macro. I mean, my whole experience is people do get very focused or very concentrated on the large picture of 5 trillion spent in, let's say, high-speed railway, etc. But what causes this cyclicality is basically all the infrastructure projects are basically, I mean, most of them rather are long gestation. So these are long gestation includes the construction risk also. And if something, dynamic of that project changes, there are those risk factor also which comes into the play because of the longer gestation period. So that is one thing. Secondly, while there is a private capex which is likely to pick up, and there is a PSU capex also which is also happening, these are all second and third order effects of a main play, which is the public infrastructure spent by the central and state governments. So if there are fiscal pressures which may arise in between, they can actually change the priorities in between, and therefore that can have an impact on the cycle per se. However, as you had seen in that slide where the longer term basis, the capital allocation or the budget outlays allocated towards the infra has only gone up, and there is an ordering pickup, etc. So those long term themes doesn't change, but interim you can have shifts in the priorities, and that can have effect. So that is something which needs to be understood, because and given the long term nature of the opportunity or long term nature of the projects, those actually things actually can actually impart a lot of cyclicality or the little bit of volatility to the earning cycle of these companies. So these are the two, and therefore important takeaway is understanding the leverage and understanding or having this valuation discipline in the sector investment is very, very important. So that was on the sector per se, and just quickly how IDFC infrastructure is, how we are positioning is, as I said, how does we compare on our 7-point framework. So this has clearly been laid out in all our outgoing communication. This presentation is also available for everybody's consumption. So we are having quite a lot of sector focus, obviously this being a sector thing, but there is also high regard for management quality and also the earnings trajectory and what kind of valuation, which I brought out in our talk also. So this is one. Then this is our sector positioning. So as I said, we are quite positive on the core cycle itself, therefore quite a large allocation towards the construction and those things. But at the same time, we are much more bullish on the cement cycle per se, therefore cement happens to be, or cement and allied happens to be a very large allocation to us. And in terms of these are the top names as of now in December, but just a sector view, if I have to give you, in terms of where we are not present is also is something of a choice. We are 0% in financial. That is something is a call. As an infrastructure fund, we don't allocate any capital to financials, also not to BFSI as in auto or pharma or those sectors, while some of the peers does have allocation or meaningful allocation to financial. That's where we don't stand. Also, we have taken a conscious call that we have not allocated very large segment, a very portion to the energy per se, is because we believe energy itself is going through a lot of transition, and perhaps the new renewable things will actually attract more capital. That's where the equity valuations will migrate also. and not where perhaps the last 5 years or 6 years of the segment are actually remaining, and perhaps they will actually also staff for the newer capital as well. So those are the 2-3 things which are differentiating us. Rest is wherever we are located in terms of cap goods, cement, building material, construction, or even engineering services, is all as per what we discussed. We are not allocated money into the coal-based power utilities as well. The reason being the same, that ESG concerns as well as the new competing energy sources will actually cap the valuation over there, and the existing utilities will have to transform their business model. So those are the things. I can take further questions whenever, or give more clarifications whenever in the Q&A. And yeah, so that's about it. Just one mention about, yeah. So this is where we don't invest. This is something which I want to highlight, that banking is something, or financial services is something which is not part of, which will never be a part of our investment allocations. We will remain very, very core sector focused, given the exposure we want to bring out. So yeah, so I'll stop here. I'll stop sharing also, and
probably you can keep that
we'll keep
slide.
it here.
Yeah.
This one.
Yeah, probably just for reference.
Sure.
So yeah, thanks a lot, Mr. Sachin, for taking us through your thoughts, your fund house's thoughts on the sector, and how it's shaping up, and how your fund is positioned to ride this current wave, current run or cycle that we are expected to see. So when it comes to questions, I don't see too many questions at this point, but maybe you can try answering. Okay. Would you have any thoughts on the you did mention it, you did talk about it, but then the expected interest rate hike, not in India, but that the Fed has initiated and will initiate in the next 1.5 year. Do you believe that will lead to any kind of a derailment of the cyclical story in India?
So I think in India, cyclicals are not perhaps expensive, especially the infra cyclicals. I don't think those are expensive anyways. The whole argument about change in the interest rate cycle per se, is not as fearful also, in my view, as what perhaps market is as of now making out. But that can impact the valuations, as well as the businesses for which the capital itself is in oxygen, because it is not actually about interest rates per se, because what level they are not going to a level which is like multiple of that. First of all, this is not 1981 where Volcker just went out and killed the economic cycle and the inflation was running way out of hand. This is not that situation. We are in a situation where there are supply chain bottlenecks, and there are inflations, and there are manufacturing bottlenecks also. And that is where they want to control. And perhaps some of the fiscal incentives, which are one-time in nature, if they go out, then perhaps the inflation risk also will kind of not look as bad. So I'm not too worried about that. But where the current tightening of the fiscal could actually impact is if some of these feel-good things actually go out, and businesses where capital is important for sustaining the business itself, they might actually starve for capital, and that's where the valuation can crumble a lot, which is what actually is, if you look at the broad picture, that is where the issue is coming through. I don't think that actually is very tightly applying to infrastructure as a theme as of now, because I think budget is like maybe 10 days away, and we'll again see the reinforcement of the same commitment. That is, I think, is a given consideration anyways. So I don't think that will be an issue. Issue in my view is basically is where how the execution will go through, because we are talking about endemic or end of the pain period per se, but this is a sector where the clarity in terms of travel, clarity in terms of movement is required, and the implementation does require you to travel or those things. Once those things start coming in, the cash flows will be moving across much more freely, and these companies will actually able to take those investment decisions also.
Sure, great. Just to get your frank opinion on something that probably a lot of investors will have in mind. Do you believe that the infra story in India is at its relatively at its most attractive point since probably 5 or 10 years or more?
So I pointed out three things. Like one is very clearly on its cement, then real estate and residential real estate especially, and then there was a manufacturing part, right? All these things, while the stocks have run up a bit, especially in real estate and perhaps in manufacturing also. But if you look at the sizes they are and look at the opportunity which is available for them to address, perhaps the scalability of that could be much higher also. We are very, very early stage in that. So my view is very positive. In fact, some of these things I actually started adding into my diversified scheme as well, because I also manage our large scheme, which is a flexi cap. So we are actually looking at valuation plus the opportunity, confluence of all these good things. That is where the comfort we're finding. So yeah, I'm actually quite positive on the theme as such, and we are there actually. So you don't have to, the infra doesn't mean you have to go down the quality curve, buy the undifferentiated businesses just because they're cheap. Actually, you can have good quality, decent quality businesses at a very reasonable valuations also.
That's true. Yeah, thank you for that. There's a question on the commodity price rally that we've seen, cement, steel, logistics, leading to do you think it can lead to unsustainable levels, or rather the question is if it is a bubble or not?
Whether commodities are bubble or not, that's the question.
Yeah.
So I'm not very strong views have on all commodities, but let's say industrial metals is where our views are. I think there is a strong supply chain reorganization itself has happened. Okay. See, in all commodities, China is like more than 50-60% of the consumer as well as the producers, without getting into very specifics. But this is broad picture, right? The world ex China is like 40 to 50%. Maybe it's steel, copper, aluminum, or name any metal, or zinc also, which is a smaller commodity, except oil which is not getting produced in China. But for this industrial metal, that has been the case. What has happened in China over last 2-3 years has been, in fact, that is something which is continuing for quite long. One is their own energy cost has gone up a lot, and all these commodities are quite energy intensive. Secondly, the global supply chains are quite strained. Okay. So, and therefore, if you want to be a very cost competitive commodity producer and a consumer, the supply chain efficiency is utmost important. So there is a inflection point which has happened in the commodity cycle, and therefore there's a cost base which has clearly shifted up. So that is something which is a structural factor. What happened during the pandemic period is some of these reasons or some of the factors also are transitional, which is called apparent demand. So perhaps the material is not available where it should be available in that time. So during that crunch period, you actually end up paying a little bit of premium. So some of those transitionary factors will settle. So we had steel going up in India like 65,000 to 70,000 rupees per ton. I don't think that will sustain, but we also had seen in the past like steel available at 40,000 rupees per ton, etc. I don't think we are going back there. I'm just talking about the commodity grade hot rolled coil steel. So we are not going there, but we are certainly going to remain above 55,000 or something. Why I'm saying is because the cost base itself has moved up. So some of the froth which is there led by the apparent demand will come down. But the structural shift which has happened on the cost base of the steel mills, especially in China, and that also applies the case more or less in aluminum or other commodities also, where the cost base itself has moved up. And there are other consideration of environment and pollution, etc., which is actually capping the capacity also. So those things will continue. So materials is actually has to be looked at from that way. So the longer term price averages have definitely moved up.
Sure. Thank you for that. You mentioned China. There is a question on the risk factors of a China plus one strategy, as China's policies can change because of the nature of their government. And do you think it is also too highly dependent on Indian government's so-called favorable nature as of now? What if it goes against the sector? Probably a new government or
Okay.
whatever.
First of all, there is no, okay, I'll answer in two parts. First of all, there is no incentive for we not welcoming the investment per se, because having rationalized taxes, having announced production linked incentive schemes, etc. This is a clear open door policy for investments as long as they are compliant. So I don't think we are, these are very structural in nature. These steps are, these are not something which are short term and therefore they will reverse just on a flip of coin. Or these are very well thought out. I mean, if you look at, this is all, entire thing is happening not just now, but there is a long series of steps which are happening, labor laws, etc. So these are not something which takes a lot of pain, as in these are something which is well thought out. A lot of think tanks has gone in. Niti Aayog actually has spent a lot of time on this, and therefore each period as we move forward, we see more clarity and more enablers kind of coming through. So that is one thing. So one should be quite assured about that. This is something which will not reverse. So we are also quite believing that. In terms of, it is not just China plus one. It is basically a supply chain reorg which is happening across the world, because we moved from just in time kind of inventories and the low cost kind of supply chain models to a model where redundancy is also important. Also, China itself has grown quite large. I mean, their per capita income, etc., is quite large. Their labor in cost, I mean, there are no more labor arbitrage per se available. So certain segments of value chain were anyway not viable over there, those are also coming through. But at the same time, in certain cases, as the scale kind of start coming in, India actually becomes much more competitive also. The segments where we are actually getting much more demands is actually where our compliance track record is much more stronger. That is a very, very qualitative factor. It is not a quantitative factor of you producing at X and somebody is producing at 0.9X. It is basically whether you're compliant or not, which is just one factor. It's very, very binary. So those are the things which are quite good. Those are again structural things. So we, and as I said, while we are worried about whether it will reverse or not, in terms of what we are addressing as of now is a very, very small segment. So even if we become 3X and 4X of what we are today, we are still be very small compared to what Chinese outputs are, or even some of the other Asian peers which is there. So this has a long way to go before it start bothering or start actually tilting the ecosystem heavily in favor of India.
Great, thanks a lot for that perspective on the government's role in how the sector can shape up. So, yeah, I believe we're done with the questions that were listed out by our participants. We can probably look to concluding this session as of now. Would you like to say anything to our audience, to our investors? Any parting thoughts on the sector?
Yeah, so as I highlighted in the presentation, we are quite positive looking at the cycle, how it is shaping up. I also highlighted some of the sub-sector specific opportunities. And finally, the slide which you have kept open is basically IDFC Infrastructure Fund solely focused on the infrastructure as an opportunity, which is while our definition per se may allow us to invest into financials, etc., but we are still kind of bringing it and keeping it to the core. So that is something which is a differentiating as well as a discipline factor for us, which will stick going ahead as well.
Sure, great. If I may ask one question, like one final question. Banks are said to be, at least some banks are said to be a proxy for the infra space or the capex revival phase. So why would you want to completely stay away from that? Thank you.
If you look at, see, this is not a pure exposure which you get, because first of all, when you say corporate banks is perhaps it becomes, in my view, corporate banking becomes perhaps sort of a bond proxy itself, because if you look at it actually get competed based on what is who has got the lowest cost of capital through your CASA deposits, and what they earn is basically a spread which is something is not where financial business actually get rewarded. Financial business get rewarded when you actually earn better yields to retail, understanding of customer and data and etc. While corporate banking is a very plain vanilla. So from a quality aspect also, it doesn't make a great sense. It can give an exposure for the sake of it. But if I buy a entity which is directly involved in the infra, and if there is a differentiating factor within that, the return potential and the opportunity potential over there actually become differentiated as well, and it has a substantial meaningful delta which can be created over there. And finally, as I said, when I'm talking about infrastructure fund, I don't want to confuse the investor about is it a financial or is it an infrastructure.
Fair enough. Fair enough. Great. Okay. Okay. You were saying something? Sorry.
No.
Okay. Good.
No.
So yeah, I guess would like to say thank you very much for your valuable thoughts and your insights on the sector and on your fund. I'm sure it was quite enlightening for a large section of our audience. So yeah, let's hope we all have something important to take away from this fund and this sector going forward, and we know how to approach it better from now on. Yeah, so just to reiterate, Mr. Sachin Relekar is the fund manager for IDFC Infrastructure Fund. It has been of late. It has been the topmost performing fund in its space. So yeah, it is definitely among our recommendations. And yeah, again, thank you everyone for joining in at this time, and staying with us for a significantly long portion of period since 4:30 in the afternoon. So again, thank you everyone. Thank you, Mr. Sachin, and hope everyone has a safe evening.